is low. Next one. So these are the next one is the cost involved. So discount fee involved, commitment fee involved, document charges involved, and legal stamp duties. So this is the legal stamp duties is nothing but a official fee for the legal complaints and currency risk premium, the extra cost for the cross currency details. So these all the costs are involved. So next one is the what is the advantages of forfeiting? See, advantages of forfeiting. Generally, this is security purpose and safe purpose of the both sides, exporter and importer. First of all, so this is the no default risk for the exporter. So there is a there is no risk also. We can say that we can say that there is no risk also. It is non-recourse financing. First of all, it is a non-recourse financing, no default risk for the exporter, and immediate liquidity. So when the forfeiter entering agreement with the exporter can avail the liquidity, quick access to the earning of cash, and no cancellation needed. Forfeiter handles the payment of follow-up. There is no cancellation. Boost up the export competitiveness. So enable offering the credit buyers. So with the help of this forfeiter, exporter doesn't have any risk. So he can maximum expand his business and boost up the exported competitiveness and improve the balance sheet. So off balance sheet financing benefits also there. So these all are the advantages and limitations. So limitations means what? Forfeiting involves only international trade, not in the domestic purpose. So it when the exporter and when importer are having one country and another country, when there is a international trade, so that time only it can be applicable, and higher cost than the traditional bank of finance. So here when it is cross border trade is there, so the cost also very high than the traditional bank financing. So here exporter side and importer side, both the banks they are going to work. So it is little bit higher cost involved. And next one is the required the bank guarantee or letter of credit. So compulsory required from the bank guarantee or letter of credit from the importer side. So without this letter of credit from the importer bank side, it will be not performed. And best for the large capital goods exports. Best for the large or capital goods. So generally, this can involve for the exporting of large capital goods only, and limited availability of emerging markets. So this is the limited available emerging markets. Now, what is the difference between forfeiting and factoring? See, factoring is different, forfeiting different. Generally, factoring we can use domestic and exports. So factoring we can use both ways, domestic and exports. But forfeiting only we can use that export purpose only. And credit period. Generally, factoring can involve only short-term agreements, short-term commitments only. Generally, this period consists that 30 to 180 days. But whereas forfeiting involves medium and long term. So maximum 180, minimum is 180 days, and it is up to 7 years also. This is we are going to see that. So simply we can say that it is the short term, and here credit period for the forfeiting is the medium and long term. And recourse or non-recourse, but for factor it may be recourse or non-recourse, but forfeiting is always non-recourse only. So instrument, here invoice will involve, but in forfeiting bills promissory notes we are going to use, and buyer guarantee. So in factoring, not always required. Generally it is required, but sometimes will give the exemption also. But whereas forfeiting Usually, that buyer guarantee is compulsory, it is mandatory. Without that buyer guarantee, the transactions will not move forward. And flexibility, factoring is the more flexible, but whereas profiting is the more rigid. It is very complexity, some little different also. So this is the difference between factoring and profiting. And evaluation and growth of the profiting. Generally, in the first time in 1960s, Europe origin started these profiting facilities. After the Cold War growth expanded the Eastern Europe trade. Then global banks supported and USB credits accessible boosted the growth. And India adoption, Exim Bank and other now offering the facilitator. Previously, only Exim Bank done this all the services. Now it is some private development banks also they are adapting and they're providing the services. And digitization, shift and online platforms are modernizing process. So this is the story about the profiting. Right. Next one is the securitization debt. So we have another 6 chapters. Next, I'll discuss. Now I will explain securitization debt. So before discussion of that, what is the meaning of securitization? What is the meaning of securitization? I'll share that. So before explaining that slide, I will talk about the securitization. What is the securitization? In simple terms, securitization involves the conversion of liquidity asset into the cash. So that is called as a securitization. So it is a process of liquidity asset converted into the cash. So securitization generally convert the liquidity asset into the marketable security that is nothing but a cash. It helps the bankers and non-banking financial corporation manage the liquidity and credit risk. This process improves the financial intermediation and balance sheet efficiency. So, as earlier said, securitization is the conversion of liquidity assets into cash. So, securitization is a process of conversion of illiquid assets on asset side of the balance sheet into the liquidity buying the creating of securities on the basis of that asset. In the process, securitization, the organizing the company will pull off the asset on the balance sheet that is nothing but accountable and sell them to the special purpose vehicle. The special purpose vehicle term will be designed securitization on the basis of characteristics. So it is a process. Organizer will transfer the asset that is accountable to the banker, remote entity establishment. The special purpose will known as a market special purpose. So here, simply whatever account receivables are there, that will be transferred into the banker. The banker can create and they can liquidate the assets into cash. Process and parties. See here, Process and parties. First of all, here originator is there, asset sold to the special purpose vehicle, and special purpose vehicle issue the securities and investor receive the return. So this entire process is there in securitization. So here securitization, first of all, originator pools the assets, collect the financial assets like loans and receivables, first of all. Then assets sold to the special purpose vehicle. So special purpose vehicles means what? So the purpose of vehicle buys the pooled assets. Whatever originator pools of assets collect, that it is going to be sold to the SPV. So they here, if you understand this diagram, this originator sells to the special purpose vehicle, and special purpose vehicle issue the security. Then investor receives the money. Then they will give the security. Then investor will receive the money. So this is the process generally we are going to observe. So here generally when we talk about the process and parties involved in the securitization, first of all originator involved, and second one is the borrower is there, third one is the special purpose vehicle is there, and fourth one is the facilitator is there, and next one is the credit rating agents is also there, and insurance investors and credit enhancement provider, banker, stock exchange, the dematerialization. So these all the parties generally involved, but among that all the parties, this originator pool of asset and asset sold of to the special purpose vehicle, and special purpose vehicle issue the security, then investor receive the returns. This only will generally happen. And next one is asset backed securitization versus mortgage backed securitization. See, this asset backed securitization is different, and mortgage based securitization is different. So asset type, generally in asset based securitization, auto loan and credit or card debt is there. But mortgageation, generally home loans and mortgages will apply. Structure, this asset based asset backed securitization very flexible, and it is short term to medium term only. But mortgage backed securities, only it can be involved long term standard only. And popularity, this asset backed securities are very popular. It is common in India, but mortgage backed securities very popular in US and European Unions. So this is eligible assets for the securitization. Generally, what type of assets are eligible for the securitization? Auto loans, credit card receivables, and commercial vehicles and educational loans, and microfinance loans, and residential mortgages. These assets must be homogeneous, performing, and legally enforces. So these all are eligible assets for the securitization. And what is the role of special purpose vehicle in the securitization? See, this special purpose role, that SPV is the very important in the securitization. Yeah. So the role of special purpose vehicle, the bank property remote the entity and isolate the assets from the originator to the financial risk, and issue the pass through the certificates, sells the securities to the investors and backed by the assets. So connect between the parties, facilitate the asset transfer and investors payments. So this SPV act as a intermediate between the that transfer and receiver. instruments of securitization. Generally, what are the instruments of securitization? Pass through the certificate, pay through the certificates, securities, and stripped securities, that is interest only and principal only sometimes, and synthetic securities using the derivatives. So these are the instruments which we are going to use. What is the difference between securitization and factoring? See, securitization, it is pool of loans or receivables, but factoring is the individual invoice. Securitization involves medium and long term, but factoring is the short term facility only. And securitization traded securities, but factoring is the not traded. And securitization involves special purpose vehicle as a intermediary, but factor as intermediary. And it is very difficult and complexity structure in securitization. Here, relatively very simple compared with the securitization. What is the advantages and limitations? Enhance the liquidity. They can create the liquidity and manage capital adequacy, transfer credit risk, and diversify the funding, increasing of investor participation. This securitization. And also there are some limitations also there. Complex of documentation. So to do this process, lot of documentation work is required. So it is very difficult for the investors also. And high legal and rating costs. So compulsory before approval, before giving that facility, there is a high legal work required. The rating cost also very high. It is depends on the asset credit quality, the risk, moral hazard, and market liquidity stress, regulatory handles. So these are the limitations of the securitization. So this is the story about securitization and forfeiting. In next class, I'll explain the black 4 and black 5. Right. So go through your material. That whatever I explained, that entire material having that total information. So if you have any doubt also, you refer that material, then you will understand very easily also. Remaining 6 chapter left. That 6 chapters I will explain. So once I want to show that once I want to show the syllabus and what we discussed, just I want to start the revision. See that syllabus, just whatever I explained previous classes. See, in financial services, we have 5 blacks actually. So in 5 blacks, already black 1 I covered that introduction to the financial services, I explained financial services and introduction of the financial services. These financial services we classified into two categories, that is fund-based financial services and fee-based financial services. So fund-based financial services already I explained, that is this leasing and hire purchasing and venture capital, that is fund-based. Already I explained that. And factoring, profiting, securitization, that today I explained, that is fee-based. So remaining left topics are Black 4 and Black 5. So Black 4, we need to discuss investment trustees, mutual funds, and constitution and management mutual funds. So after that, merchant banking and credit ratings, that is merchant banking, credit rating agencies. So next continuation classes, Black 4 I will complete, and next one is the Black 5 is completed. So to understand this subject, it's very simple. Just you concentrate this first chapter for about this Black 4, Black 3, Black 5. About this remaining 4 blacks, briefly here, entire syllabus is covered. If you have minimum knowledge about if you have good knowledge in Black 1, these remaining blacks are very easy and very simple. So automatically you able to understand. So without reading this, you are not able to understand this one. So focus on Black 1, that particularly unit 1, unit 2, unit 3. Then remaining units are very easy. So up to now, I explained that 9 units and remaining 6 units are there. Next classes, I'm going to complete that. Yeah, thank you. Next class, I will complete the remaining units.